Hi, welcome back to this mini video series where I build a financial spreadsheet entirely from scratch. If you haven't done so already, please go back and start with the first video and work your way up from there. In this video, I'm going to be adding expenses to give us an idea of how much money it'll cost us to either have our asset managed by active fund managers or our index trackers, which I'd highly recommend in most people's cases. My name is Lars Kroyer. I'm a former hedge fund manager who's written a couple books about finance, and I'm now doing these videos as a hobby. I'm not a financial advisor, so please do your own work before you do anything I say in this or in any other video. But let's get straight back to it. So here we are back at the spreadsheet, and like always, I'm going to start by making a copy of this sheet. So let's see, create a copy, go down to just move it right before the cheat sheet, and let's call it adding fees. Now let me start by doing a bit of household items. You can see here I made a mess. I didn't realize, but I made a mess of these two things in the last video, which the cells didn't copy right. But in any case, I don't think it really makes sense to have max and min as two of the entries here because frankly, the numbers get so absurd. You've got to keep in mind you're talking the 1 out of 1,000 cases. So, you know, this number is so big we can't even see it, but it'll be above 100 million, and this would be 21 million with these kind of contributions. It's not that it's unrealistic. It's just it's the best out of 1,000 cases, which is kind of meaningless to show. So I think what makes sense is to maybe have other cases that we show. So maybe have a best case, a worst case, a case above zero, and in this case, a case above 500,000, which you can easily change. So let's start by adding the case above a good case, let's call it, and let's call this the worst instead of fifth percentile. So we say worst and text, and then first 5%, let's call it. So there you go. So that's sort of something we can all understand. Let's copy this down. And don't forget you have to change the cells because when we copy down, you see it's C110. And then when you copy down, it becomes C111. So you got to make that C110 to C09. Just checking that that's the same. So now we copy that out. And then let's make this the best. So call it best 10%. So instead of making it worst, we make it the best. Just again, so it's easy to understand what we're looking at. Best. And then what this should be is the, let's see here, this should be 1, let's do parentheses around this, 1 minus this number. Is that right? Yeah, best 10%. So now we have worst 5%, best 10%, cases above 0, cases above 500,000 in these numbers, which is exactly what I think we should be showing. We can obviously, if you want to say best 20%, you make this 80, and that'll filter in. If you want to, let's make it 10. If you want to make it not worst 5%, but worst 10%, you put in 10% here, and it should all filter through. So I hope that makes sense as something we should be showing. So let's, instead of these max mins, let's just copy down here exactly what it is we're showing. Worst 5%, best 90%, case above 0, case above 500,000, and then let's make these equal to, if we get this one, and then I'll show you a neat little way we can copy. And then we copy just paste this, but now you see these numbers are no longer percentages, so let's make these percentages, and there you have it. So I think this is a much better thing to be showing. First of all, we corrected the small error we had from the last spreadsheet, but also this is more in line with what I think makes sense to show what we care about. By the way, a friend pointed out that the 5% is perhaps a little bit punchy in terms of an assumption on compounding. So to make my friend happy, let's make it 4.5. The standard deviation is also punchy, but I think let's keep that for now. We can come back to making it lower, but then building in fat tails. So now, finally, I'm ready to start talking fees. So what I want to do is I want to add a line up here where we say, call it active fees, if any, or additional active fees. Oops, let's copy this cell down, or this row down. There you go. Active, additional active fees, if any. Now, this is something I am actually a huge proponent of. Please check out my videos about whether or not you can outperform the market. If you can't outperform the market, you should buy index trackers. That's my overwhelming belief. It's my belief that you would pay an average of, say, 1.75% additional in fees and expenses. Lots of unknown expenses to you probably in the active management, and it's probably even worse if you manage portfolios yourself, unless you're a superstar at it. So let's just, I want to give you an idea of the magnitude of this. So let's call 1.75% in equities. And just for simplicity, let's say it's a fifth of that in the minimum risk asset. Maybe, I don't know if that's exactly fair, but let's keep that for now. So then what we do is we know now we're going to get a lower amount by these fees. So let's just subtract them. And copy that out like that. And now let's make a bit of room over here. Insert a row. Let's do a couple actually. And then estimated active fees. And then let's make that underscore italic. And then let's use the median. Now, the median, I think, is a reasonable number to use because we are, you are likely to be the 500th luckiest or unlucky person, the median person, not the mean person, because the mean will include some sort of corner solution, some corner scenarios like the crazy max cases we had before that that you're not likely to get on average, obviously. So median is the right number to use. So let's use the median passive. Then let's use median active. Let's use estimated extra fees, and then let's use that as a percent of total contribution. Let's make that italic also. So now this is where it's a little bit of a fudge. So I don't actually want to build this into the model because I think that gets a bit messy. I'm very, very keen to keep this model simple. So again, I've shown you this before. I basically, instead of formatting, I copy these cells in and delete them. So now the formatting is in the cell. So now because we see here the 1.75, it's an active, it's an additional fee. You can make it 2, you can make it 1, you can make it anything you want. I think 1.75 is probably pretty accurate number. So now what you see, let's recalculate. To calculate, so now the model is sort of spinning around. This, by the way, will depend on the speed of your computer, which says a lot about the speed of my computer right now. There you go. So now what we do is we copy these, we go down in the active row, and then we go edit, paste special, and we copy the values. Now, this is a complete fudge, guys. So this is not hard-coded. You're going to have to change this every time. So let's make it blue. Now what we go do is we make it 0. So now we're index tracking, which I think is what you probably should be doing. Again, check out the videos, recalculate these numbers. They're going to be much higher because now we're not paying the extra fees of the active management, which doesn't make sense to do. This is, by the way, so there we go, it finally came through. But what we're seeing is that the model, because we've got all these sheets doing lots and lots of calculations, we actually no longer need, because we make a new sheet every time. It may actually make sense for us to create a new workbook and start afresh just with the sheet. But now let's copy these numbers down. And so again, we go edit, paste special, and you copy the values. There you go. And then let's make these blue. So let's make this, highlight the whole row, make that blue. Now, what you see the difference. So this is pretty staggering stuff, right? So now, this is real, by the way. This is not just some spreadsheet aberration. This is real difference in expected values for active management as opposed to index tracking. I really firmly believe that. So if you just look at that, right, you paid an extra fee. Let's call this dollars just to pick. You would, in this model, put $4,000 aside for most of your working life. You take out $10,000. You put it, in this case, all in equities, which is obviously a pretty aggressive assumption. As a median, you end up with just under $1 million. If you are index tracking, you end up just under $500,000 if you invest in active management, which the majority of people do, or if you invest money yourself in equity markets, i.e. trying to pick Microsoft or Apple or whatever. Don't do it unless you have an edge, but you will have paid $500,000 in fees and expenses that you don't have to pay. So let's make that divided by your total contribution. So that's the max number in this column. So this is basically saying divided by what you contributed. So let's make that a percent. And then let's copy that out so we make the I constant. So we 56, bloody hell. There you have it, right? So you will have paid more in fees than you contributed. So the final thing I just want to do is I want to make a note to ourselves. So when we look at this spreadsheet after 6 months, or note to self, rerun calculations, then copy, paste values in before and after changing the assumptions. Does not automatic, don't remember recalc. Actually, don't recalc, we've sort of already done. Rerun calculations, change after fee assumptions, yeah. You can say it does not happen automatically in model. Happen automatically in model. That's a bit of a long sentence, but there you go. So here we have it. But now we've shown it. You have, and keep in mind, every time we run this, the numbers will come out slightly different. You see here now it's 587,000. Let's recalculate. Because we have the random function we walked through before, the numbers are going to come out a little bit different every time. Not massively different, but a little bit different. But accept that, and then we would have to copy down the new numbers every time. You see they're slightly different, a couple of percent different in this case, so not materially, and the argument holds with these extra fees. So in summary, it's hugely important. Don't ignore fees. Try to minimize it unless you have a magical ability to beat the market. Now, depending on your assumptions of how much you put in and what kind of asset allocations you have, you can get a sense for how material these extra fees are. But almost in all cases, the answer is it's hugely material. Don't ignore it. And now we've incorporated it into the model to give us a sense for exactly how important. Guys, this is recording after the fact. I noticed I made one mistake. You say it's the best 90%, which is really another way of saying the worst 10%. So down here in the model, we should make this 90%, which is now the best 10% in the model, and not the best 90%. What you see is obviously that the numbers get substantially better. So that was a minor correction made after the fact. Sorry about that. So thanks for watching. I hope that was interesting and useful. You can subscribe to my channel if you want to hear about the next installment in the series. But in any case, I hope to see you in a future video.